Just when you think the banking sector is safe and we're out of the 2008 crisis, Silicon Valley Bank collapsed within 48 hours, and we've just witnessed one of the biggest bank failures in modern history. But why did it happen? And how can a bank just completely collapse overnight? The big question is our money safe, and what led to all of these circumstances where a bank literally collapsed in 48 hours? Ooh, it's a smoky one. Is this a sign of things to come, and why are other banks like Credit Suisse starting to crumble? I'll explain the collapse of Silicon Valley Bank in a simple and easy to understand way. And I need to break this down into three main sections, looking at how banks work, what happened to SVB in 2020, and how SVB started to collapse. Really, this is to help address the questions of, is your money safe and are you protected? So grab a cup of coffee, sit back, and let's dive in. Firstly, we need to look at the basics of banking. Let's understand how banks work. Banks take deposits from people and businesses and then lend that money out to others. The deposits is known as liquidity. Now, banks need to make sure that they have enough money in their accounts to lend to others while following all the rules set out by various governments. So when you see the headlines talking about there's not enough liquidity, all they're effectively saying is that there's not enough deposits or money in the bank to fund everyone's withdrawals. Now, there's something known as fractional banking. In a nutshell, if you lend me £10 or $10, I as the bank need to make sure that I keep $1 or £1 available for withdrawals at any one time, and I can invest the other £9 to make money on it. At a large scale, they should always have enough money to easily fund withdrawals when customers like you and me want our money back. It relies at the same time on faith that all banks have money available to give back at any point in time that you need it. And there's also a hope that all of the customers don't ask for all the money at the same time. Now, usually this all works fine, apart from in this case with SVB. So how do banks make money on your deposits that you store with them? Banks need to earn money on their deposits so that they don't lose money while covering their expenses. One way they can do this is by lending money to borrowers. Another way is by investing the money in safe financial instruments like US Treasuries, which earn interest over time. You have to remember a bank is effectively a business or a company. They'll have operating expenses, staff to pay, buildings and offices to manage, software, all of the usual stuff that comes with running a big company. With lending money out being a very popular way of making money as a bank, this is why it's heavily regulated by central banks so that the banks don't lend out money to very high-risk people or businesses or initiatives, whatever it is they're giving the money to, so that they can limit the amount of risk where customers default on that money. So when you want to get a loan or a credit card from your bank, you're using other people's money stored with the exact same bank, which then the bank charges you interest, which is one of the ways they make their money as a business. So what happened to SVB in 2020? Well, there was a surge in the tech sector in 2020. Everybody went online, and after the pandemic, there was a massive surge in the tech sector. Stocks increased, valuations were really optimistic, and money was flowing through the tech sector. Many private equity and venture capital firms started investing heavily in technology companies. As a result, SVB, which focuses on the tech sector, received a huge influx of deposits from these firms. With more than an extra $200 billion in deposits, SVB faced a core problem. They couldn't lend the money out fast enough due to the booming tech industry. They needed to find ways to put their money to work hard enough to earn interest and cover their expenses as a business. So SVB decided to invest into what are historically safe investments, which is a US Treasury. It's like putting money in a special savings account that earns interest over time. This way, they could make money on the cash that they had lying around. For example, if I go to the bank and say, hey, I want to lock this money away for 5 years, and the bank say, sure, you can get it back in 5 years' time, and we'll give you 2% for it. Well, when SVB bought the US Treasuries, they agreed to receive a fixed interest rate over time, like when you put money in a savings account. However, the interest rates increased from 2% to 4 to 5% by the central bank. When this happens, the value of treasuries goes down. So SVB lost money because the bond prices fell. They made a huge bet that the central bank wouldn't raise the interest rates, but this turned out to be very wrong. The problem is here, when I could now, a few months later, get the same product but at 4 to 5% interest to make more money, it effectively means the value of the original 2% treasury bond they took out is worth a lot less in real terms, and thus that starts to create the problem. This started to create a bit of a panic among all of the customers who are all in the exact same tech sector. They started withdrawing their money from the banks, and the banks need enough cash to cover these withdrawals. So SVB had to sell their treasury holdings at a loss to get that cash back to satisfy all the customer withdrawals. What they also got wrong here was not just hoping that the central bank wouldn't increase the interest rates, but also that venture capital funding would remain high, so they still have lots of liquidity from customer deposits. But also the tech sector took a beating in 2022 with a lot of VC funds drying up or tightening their wallets altogether, meaning less money was also flowing into the bank to cover all of these problems of lots of people withdrawing all at the same time. And then this effectively creates a vicious cycle. The more people withdrew money, the more SVB had to sell their treasuries at a loss, and this creates this vicious cycle that made the situation even worse. When SVB announced plans to raise more funds by selling stocks, it only fueled the panic and led to even more withdrawals. And they fundamentally did what average savers and investors like me and you try not to do. We try not to lock all our money away in a single asset for a low return when either we could get a higher return somewhere else in the future or need the money to pay for an emergency. And it was that second scenario that happened with SVB. But also we have to talk about SVB's concentration risk on the tech sector. It meant that they had this huge niche where if one market starts to freak out or they have tons of capital, the problem is that's why they can't lend it out quick enough and make money on their money. Larger banks with customers from many sectors are less likely to collapse because when one industry faces problems, everyone else seems to be kind of okay. That's not a given, but it means that there is some stability for the larger banks. But here's the real kicker. If you own stocks in your stocks and shares ISA or your Roth IRA if you're in the US, and it's worth $10 and it's gone down to a value of $7, you haven't actually lost that money until you realize the stock by selling it, and then you lock in the loss. It's only if you sell. And this is what happened to SVB. They were forced to sell their treasuries at a loss. They could have held on to them for 10 years and still got that 2% return and all would have been okay. But because that first domino fell, online everyone's freaking out and it caused this cycle where more people get scared, more people take more money out, and then SVB need to keep on selling all of these treasuries at a loss more and more and more, to the point where $40 billion went out in one afternoon that crashed the bank. This was the final blow that caused SVB to collapse. The bank just couldn't keep up with the demand for cash, and the vicious cycle of selling assets at a loss to cover withdrawals ultimately led to its downfall. And that core principle of the fractional banking model, where they keep £1 in every 10 available for deposits, was impossible for them. Their hand is forced, they lose more money each time they sell, and their position is always at a loss to fund all these customer withdrawals, and then the whole thing collapses. And there we have it. We have quite literally witnessed one of the biggest banking collapses in recent history. More could go down, but it's a very interesting story. And that is the end of SVB. If you found this video useful, then check out this one here, which explores whether you should buy a house now or wait in the property market with how volatile house prices are right now. So check out this video here.